This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. This lecture goes with Chapter 12 of the P4 course notes and is on share options and option pricing, which is page 61 of the notes. First of all, what we mean by a share option. A share option gives you the right to buy or sell a share at a fixed price on a future date. And to denote whether we're talking about buying or selling a share, if we're buying a share, it's a call option. So a call option is the right to buy a share, again at a fixed price on a future date. Whereas if you want the right to sell a share at a fixed price, we call it a put option. The right to sell a share again at a fixed price on a future date. So, a call is the right to buy, a put is the right to sell. Now we can discuss later in more detail why you might want an option, why you might use options, but it could be as simple as you think the price of a share is going to increase. You can't afford to buy the share today, perhaps. You're thinking you'll be able to afford to buy it in a month's time. Well, wait a month and obviously the price may have gone up substantially. So you might decide to buy an option today to give you the right to buy the share at that fixed price. So even if the price has gone up, you can still buy it at the fixed price. However, it's an option because you don't have to buy or sell the share. You don't make the decision until the future date. Let me explain what I mean. If you look at example 1 on page 61, the share price of Madrid plc is currently $2. We have a call option with an exercise price of $1.80, exercisable in 3 months' time. So we've got that option, and in 3 months' time, we've got the right to buy one of those shares at $1.80. And the question says, what will Johnson do if the share price in 3 months' time is A, $2.50, B, $1.50? Well, it's in 3 months' time that Johnson decides whether to use or exercise the option or not, and he'll do whichever's best for him. So if part A occurs, the share price is $2.50. His option gives him the right to buy it at $1.80, so surely he'll exercise the option. If he wants the share, he's obviously better to pay $1.80, the option exercise price, rather than the market value of $2.50. Even if he doesn't want the share, surely exercise the option and buy it at $1.80. He could then immediately sell the share at its then value of $2.50. However, in part B, what will he do if the share price is $1.50? Well, of course, there's no point at all in exercising the option. Why pay $1.80 for a share that you could have bought on the market for $1.50? So the answer to part B, do not exercise the option. So that's essentially how it works. You wait until the exercise date, and then it's your choice whether to exercise or not at the exercise price. The only thing is, though, that of course that option, that right to deal in the share, won't come free. You'll have had to have paid for the option. Look at example 2. Very, very simple one. It says the share price of Lisbon is currently $2.50. A call option is available with an exercise price of $2 and it's exercisable immediately. And it says what is the value of the option? How much would you have to pay for that option? Well, surely if it's exercisable immediately, the option gives you the right to pay $2 for a share that's actually worth $2.50. And so surely the value of the option, if you can buy a share for $2 that's worth $2.50, surely the value of the option would be the difference. It would be 50 cents. It's a rather hypothetical situation, but you pay 50 cents for the option. It's exercisable immediately. You'd clearly want to exercise and pay $2 for the share. In total, you'll have paid $2.50, and that's what the share is worth. However, that's clearly too simple and too obvious. The problem is this: what happens with example 2, for example, if the share price is $2.50, a call option's available at $2, but suppose it was exercisable in 3 months' time. Because in 3 months' time, of course, the share price could be anything. It may stay at $2.50, in which case in 3 months' time you'll exercise and at $2. It may have gone up to $2.80. It could have gone down, of course. In 3 months' time it may have gone down to $1.80 and you won't exercise. But the point is, how much would you have to pay for that option if it wasn't exercisable for 3 months or 6 months or whatever? And surely the amount you'd expect to have to pay will depend on various factors, which are listed at the bottom of page 62. I think the first 2 factors are fairly obvious. Factors that will affect the price, certainly the current share price and the exercise price. You've just seen that in example 2. That those 2 are certainly factors that will affect the price. Another factor, though, will be the time to expiry. Is it exercisable immediately, or is it in a month? Is it in 3 months? Is it in 6 months? Because surely the further into the future, the more likely that that share price in fact will have gone up. Maybe it'll have gone down, but the longer the period, the more likely it is to have changed. A jumping one, the last one, the volatility of the share price. What I mean there is if historically, look back at example 2, if historically the share price has always been $2.50 and it's never ever changed, I think there's a fairly good chance that perhaps it'll still be $2.50 in 3 months' time, in 6 months' time. On the other hand, if that share has a history of changing share prices, then of course there's much more chance that the share price will be a lot different in 3 or 6 months. And finally, the risk-free interest rate. This is simply to do with the time value of money. That if it's not exercisable for 3 months, it won't be until 3 months that you're having to potentially spend the exercise price. Well, effectively, we need a little bit of discounting to be affected by the risk-free interest rate. Well, you can be expected to actually put a value on an option. And to do so, well, Mr. Black and Mr. Scholes developed a formula which is very, very widespread. It's very commonly used by option dealers to arrive at the price to charge for an option. And the formulae actually look dreadful. They're not as bad as they seem, but you will need a scientific calculator. If you look on page 63, you'll see there the formulae. The value of a call option is on the first line. C is PAN brackets D1, etc. Obviously, I'll explain it shortly. Where D1 and D2 are those formulae below. So we'll use that formula to value a call option. If it's a put option, well, again, I'll explain later, but it's the formula further down. Put option, the value of a put plus current value of underlying asset equals value of a call plus present value of exercise price. Well, again, these are the formulae. You're given the formulae in the exam. The problem, as always, is knowing what the various symbols mean and then actually being able to use your calculator. Plus, as you'll see a little bit in the middle of it, we need to use normal distribution tables, which again you will be given in the exam. Well, to explain how it works, let's look at example 3 together on page 64. Example 3, it says the current share price is $2.90. This option has an exercise price of $2.60 in 6 months' time. The risk-free rate of interest is 6% per annum. And the standard deviation, the volatility effectively, but the standard deviation of rate of return on the share is 40%. Now you'll be given all that information in the exam. If you get one of these questions, your job is to work out A, what's the value of a call option, and B, what's the value today of a put option. So, refer back to the formulae on the previous page or on the formula sheet. Let's first of all sort out what the symbols are. Well, the symbols in the formula, PA is the current market value, which in our question is how much? Well, the current share price is $2.90. Now, just for simplicity, I'm going to work in cents. I think it's easy, it doesn't matter, but it's 290 cents. You'll also see in the formula PE. Well, PE is the exercise price. And again, back to example 3, the exercise price is $2.60. What else? Well, there's R and T. R is the risk-free interest rate. In our example, the risk-free rate of interest is 6% per annum. It's the annual interest rate, and express it as a decimal. So it's 6% a year, or 0.06. Nearly there. T is the time to expiry in years. So no problem, but do be clear what I mean. In our example, these options are exercisable in 6 months' time, so the time to expiry is 6 months. And of course 6 months is half, or 0.5 of a year. Finally, you'll see it's in fact in the equations for D1 and D2, you'll see the symbol S. Well, S is the measure of the volatility. It's the standard deviation. Of the rate of return on the share, which here is 40%, but again expressed as a decimal, so it's 40% or 0.4. So that's what the main symbols mean. You'll also have noticed in the formula there's the letter N. Well, that actually means it's telling us to look things up on normal distributions. I'll explain that when we come to it. You'll also see the letter E. E is a constant, like pi, but it's a constant. It actually equals 2.7183, but with a scientific calculator you will have a button somewhere with E on it. So we'll check how to use the calculator as well in a second. However, we're going to work out the value of a call option, and you'll see in the main formula C equals PA n brackets D1 minus PE n brackets d2 times e to the minus rt. In order to complete that, we need to know the values of d1 and d2. So the first thing we're going to have to do is work out d1 and d2. Those are the equations that are given below. So let's do that. d1, first of all. The equation for d1, it's ln brackets pa divided by pe plus brackets r plus 0.5 s squared times t divided by s root t. Now the first bit on the top, ln, is log to the base e. Now we're not going to have a logs lesson. It'd be quite irrelevant, to be honest, for the exam. But again, you must have a button on your calculator which has ln on it, and obviously be able to press it. So as I keep saying, you need a scientific calculator. But it's log to the base e. It's ln of pa over pe. Well, pa here, current market value is 290, divided by pe 260, plus r. R was the risk-free interest rate, which is 0.06, plus 0.5 times s squared. S standard deviation is 0.4 squared, times t. T, the time to expiry, what was it, 6 months? Yes, so t is 0.5. Divided by s, 0.4, times the square root of t, the square root of 0.5. Check your calculator with me. ln of 290 divided by 260, well, on my calculator, we do 290 divide by 260, which comes to 1.115, etc. You then press the ln button, and it gives us 0.1092. I'll talk about how many decimal places to go later, but 0.1092. Do be careful of this one. You'll see in the next example, I think, that in fact this can be negative. And so do check. Here it is positive, but clearly it will make a big difference had the answer been negative. Plus, well, I want to do the whole of the next bit on my calculator. If I start with the end bit here, 0.4 squared times 0.5 is 0.08. If I add 0.06, I get 0.14. And if I then multiply by 0.5, I get 0.07. Divide by, well, the square root of 0.5, so 0.5 root is 0.7071 times 0.4, I get 0.2828. Finally, for this little bit, let's do it. 0.1092 plus 0.07 divided by 0.2828 gives me 0.6337. So that's one little bit out of the way. There's D1. However, we still can't go to the main formula yet because we need D2. And if you look back to the formula sheet, D2 is D1 minus S root T. Well, hopefully no problem here. D1 we've just calculated, 0.6337. S 0.4 times the square root of T.5. Which, check me, but I think gives us 0.3509. Now, one more little point before we carry on with this. You will see in later examples either or both of D1 and D2 could end up being negative. If you don't worry about why, as I say, you'll see it happen in later examples. Here they are both positive, but it does matter, and be very, very careful. You can certainly see how D2 could be negative because we're taking D1 and then subtracting something. Again, here they are both positive, but I can't stress enough, be careful. All right, now we've got them, we can go to the main formula. Well, the main formula again, C is PA, ND1, etc. But we now need to sort out what we mean by ND1 and ND2. And what the N means, it means we're going to look up the bit that follows, D1, and in the second case D2. We're going to look it up in normal distribution tables. Now, these are given in the exam, and they're at the beginning of the course notes. They're on page V of the course notes at the beginning. But there's a set of tables headed up Standard Normal Distribution Tables. Now, you may have seen normal distribution tables before, but these are laid out slightly differently than you might be used to. And there's a little trick. So make sure you're happy how you use the ones that are given in the exam. The ones on page V are the same as the exam ones. We're going to look up, first of all, ND1. Now, we worked out D1 earlier. We got plus 0.6337. As you're about to see, you can only actually use the tables to 2 decimal places. So if I change it to 2 decimal places, it's n of plus 0.63. And the way we use it is this. It's a little bit strange, so be very careful. From the tables, we look up the bit in the brackets D1. We ignore the sign, so for the moment whether the 0.63 is positive or negative is irrelevant. And to look up the 0.63, down the left-hand side of the tables you'll see 0.0, 0.1, 0.2, 0.3 and so on. Well, we go to the row that's got 0.6 against it. We go along that row, and the headings at the top, it gives you a second decimal place. So the first column will give you 0.60, the second column 0.61, 0.62 and so on. So we want the row that says 0.6. So it's the 0.6 row. The column that is 0.03. And if you check me, the 0.6 row, the 0.03 column, gives a figure of 0.2357. So once you've got the hang of it, it's easy, but make sure you can use the tables properly. Don't write down in the exam 0.6 row and 0.03 column, but the answer is 0.2357. However, there's now one little trick that I said to you earlier, that D1 here is 0.63. Although ours is positive, it could have ended up being negative. It could have been minus 0.63. Well, first of all, you look up the 0.63. Ignore whether it's plus or minus. So whichever it was, you'd get 0.2357. But the rule is this, that if D1 is positive, if it's greater than 0, as it is here, you add the table figure to 0.5. We'll take our table figure of 0.2347 and we'll add 0.5. On the other hand, although irrelevant for the moment for this example, if D1 is negative, if it was less than 0, now remember, had it been minus 0.63, you'd still have looked up 0.63 in the tables the same way, but you then subtract the table figure from 0.5. Now it looks very strange. In fact, it's not hard at all. And, although you'll soon get used to it, if you look at the very bottom of the tables on page V, it says this table can be used to calculate ND, the cumulative normal distribution function needed for the Black-Scholes model of option pricing. But it then gives you the rule: if D1 greater than 0, i.e. it's positive, add 0.5 to the relevant number. If D1 is less than 0, so it's negative, subtract the number from 0.5. So the rule is there. It doesn't matter if you forget, but remember that there is the rule needed. And let's apply it here. Here it is positive, so ND1 is n of plus 0.63. Well, we'll add 0.5 to the table figure, and it gives us 0.7357. Now I'll illustrate the situation later where it's negative, but in fact had it been negative you would simply have done 0.5 minus 0.2357. Well, in a similar way we need ND2. Exactly the same approach. What was D2? We worked out it was plus 0.3509. The tables you can only use to 2 decimal places, so 0.35. We'll take the table figure, and because it's positive, we'll add it to 0.5. So it'll be 0.5 again, but the table figure, it's the 0.3 row, it's the 0.05 column, and the 0.3 row, the 0.05 column, gives us 0.1368, a total of 0.6368. Nearly there. Now let's go to the main formula. The main formula, let me write it down again, then there's no confusion. But the main formula, C is PA ND1 minus PE ND2 times e to the minus RT, which is what? PA, check back, but the current share price was 290. I'm working in cents, remember, times ND1 0.7357. PE was the exercise price, in cents $2.60, 260 rather, times ND2 0.6368 times E, which is a constant, to the power minus R, the risk-free rate 0.06, times T, the time to expiry, half a year 0.5. And in fact, I'll immediately simplify that. Excuse me, I don't think I need an extra line. 0.06 times 0.5 is 0.03. So it's to the power minus 0.03. Well, the first bit of that, of course, is easy. 290 times 0.7357 is 213, and at this stage do things to the nearest cent. There's no problem, a bit of rounding, unless of course you were told to do different. The second bit, though, there is the one extra complication, making sure that you're able to calculate e to the minus 0.03. Now here you may well have to practice with your calculator, but with a scientific calculator somewhere you'll have an E button. In fact, mine has a button e to the power x on it. And make sure also you can do things to the negative power. Now what you can do, you may remember from school, e to the minus power is in fact the same as 1 over e to the positive power. But in fact, I think with just about any scientific calculator, you should be able to use deal with a negative power. Now I'll show you what buttons I press, but I'm afraid every calculator is different, so you are going to have to practice, and if necessary, obviously look at the instruction book. But if I just do e to the minus 0.03 on its own for the moment, I'll tell you which buttons I have to press. What I have to do is this. I have to press, in this order, I press 0.03, so 0.03, and showing in my screen is 0.03. I then need it to be negative, so I've got a button with plus minus on it. I press that, and the screen now shows minus 0.03. I then want to press the button that says e to the power x. Now with mine, it's above the ln button, so in fact I have to press a button saying shift, and then, because it's in yellow, e to the x. So shift, e to the x, and what shows on the screen now is 0.970445533 and so on. So, for the last time, every calculator is different. If yours has different buttons or uses a different logic, practice, read instructions, but there's the answer you're looking for, that e to the minus 0.03 is 0.97. Boom, boom, boom. However, to go back to the equation, although that gives me this bit of it, keep it in my calculator and multiply by the other two. So multiply by 0.6368 by 260, and it comes to 161 if again we keep to the nearest cent, which finally gives us 52 cents. Now, I'm sorry that's taken a while, but clearly if you've followed me, when you've done one or two, it gets faster and faster. It is speed on your calculator more than anything. But that is the value of a call option. If you were buying this option in example 3, if you were buying a call option, the right to buy at 260 in 6 months' time, you'd have to pay 52 cents now. You pay your 52 cents. In 6 months' time, the value may be below 260 and you'll throw away your option and you've lost your 52 cents. If the value is higher than 260, of course you'll exercise your option. Buy the share at 260, and if you want to immediately sell it, but you'll still have had to pay that 52 cents. However, just as you're able to buy a call option, the right to buy at a fixed price, equally, you can buy a put option. And remember from earlier, a put option would be the right to sell at a fixed price. And so what we're going to do for the same example is work out what the value would be now of a put option at $2.60. And so all the figures are exactly the same as before. It's example 3, remember. And to value a put option, we use what we call put-call parity. Now that's at the top of the second page of the formula sheet, or again it's listed on page 63 of the notes. But the put-call parity formula, P equals C minus PA plus PE, e to the minus RT. P is the value of a put option, which is what we're after. C is the value of a call option. So in fact, for the exam, valuing a put option is actually less likely, because in order to value a put option, you always need to value a call option first. So you'd always need to have done part A of this question, even if it was a put option we were ultimately after. The other symbols we've already had, of course. PA is the current market value of the share. PE is the exercise price. R is the risk-free interest rate. And T, finally, is the time to expiry. So this last step should be reasonably quick. Let's check. We're after the value of the put option P. The value of the call option we just worked out, 52 cents, minus the current share price, 290 cents, plus the exercise price, 260, times E to the minus. Well, again, remember, the risk-free interest is 0.06. Time to expiry is 0.5, so R times T is 0.03, which is 52 minus 290 plus, well, I showed you how to use e to a negative power before. It was something like 0.97, but if I do it precisely, 0.03, make it negative, shift e to the power x, it's 0.970445533, multiply by 260, and to the nearest cent it's 252. And so the value of a put option, 52 minus 290 plus 252, is 14 cents. And there we are. A call option, 52 cents. A put option, 14. And before I leave it, don't leave silly answers in the exam. We can all make silly mistakes, obviously. There's a lot of calculations involved here. But just look at your answers and make sure they make sense. At the moment, the share price is 290. Now think of the call option. The exercise price is 260. Now, if you were able to exercise today, you'd pay the difference, 30 cents. Here, we've got the right to exercise in 6 months' time. So in 6 months' time, we can still buy it for only 260. And of course, anything can happen to the share price, but as far as the dealer's concerned, there's a good chance, surely, that the share price will be higher. Surely the dealer's going to charge you more than 30 cents. Now, that doesn't prove our answer's right, but the fact that it's more than 30 cents, surely, is sensible. If I'd got less than 30 cents, in this particular case, well, I think there was something wrong. What about the put option? Again, I'm not going to sort of prove that that's right, but put option would be the right to sell at 260. Now, of course, if it was exercisable today, it'd be worth nothing at all. There's no way you would sell at 260 using the option, when the actual share price, you could have sold it at 290. But you'll still have the right to sell at 260 in 6 months. And in 6 months' time, just as the share price may have gone up, equally it may have gone down. And of course, if the share price has gone down and it's gone down below 260, you'll be able to make a profit, sell at 260 when it's actually worth less. And so the option dealer, even if you think it's unlikely, the option dealer is going to charge for this. But I'm not surprised with these figures that the price is a lot less than a call option. The share price is already higher than exercise price. It may go higher still. It's going to have to drop quite a long way to make a put option profitable. However, the main thing obviously is the numbers. We'll have a go at one more. There are 3 more in the, sorry, I beg your pardon, there are 2 more in the notes. I'll do both of them, but it's up to you. If you want to pause and have a go at the next 2 yourself, do. Or watch me do example 4 and then do example 5, or whatever you want. However, I'll go straight on with example 4. And so let's see how efficient we can be. First of all, the symbols. PA is the current market value, the current share price. This time I'll work in dollars. It's 35. PX, PE, I beg your pardon, is the exercise price. The exercise price is 35 as well. T is the time to expiry. Here it's 1 year. R is the risk-free rate, 10% or 0.1. S, the volatility, the standard deviation, 20%, 0.2. D1 and D2 first. So D1, back to the formula sheet. D1 is the messy one. It's ln PA over PE. So 35 divided by 35 plus R plus 0.5S squared, so R 0.1 plus 0.5 times 0.2 squared times T. T is 1, sorry. Divided by S 0.2, the square root of T, the square root of 1. Well, 35 divided by 35 is 1. Ln log of 1 is 0 plus, if I start with the end, 0.2 squared times 0.5 equals 0.02 plus 0.1 times 1 is 0.12. Divided by, well, the square root of 1 is 1, so divided by 0.2. D1 comes to, I beg your pardon, 0.12 divided by 0.2, it comes to 0.6. What about D2? It's D1 minus S root T. 0.6 minus 0.2 times root 1, which is 1, so it's 0.4. And they're both, remember, they're both positive. Now let's look them up in the normal distribution table. So ND1, first of all, is n of plus 0.60. It's positive, so we're going to add the table figure to 0.5. And from the tables, 0.60 is 0.2257. So ND1 is 0.7257. ND2 is n of plus 0.4. Again, positive, so add to 0.5, and 0.4 from the tables is 0.1554. Now we can use the big formula, the value of the call option. PA ND1 minus PE ND2 e to the minus RT. PA was 35 times ND1, 0.7257. PE is 35 times ND2, times e to the minus. Well, r was 0.1, t was 1, so RT is 0.1. First term, 35 times 0.7257 is 25.4. The second one, well, I'll do the e first, so 0.1, make it negative. E to the power minus 0.1, I get 0.9048. Sorry, I wouldn't normally write it down, I'm only doing it if you're checking. But carry on multiplying times 0.6554 times 35. It comes to 20.76. And so the value of the call option is the difference. These were dollars, remember, so $4.64. I said earlier that to ask you for a call and a put in the exam, I think is almost impossible. But to be safe, let's do it. Having got the call option, the put option is C minus PA plus PE, e to the minus RT. Call option, $4.64. PA is $35, PE is $35, times E, again to the minus 0.1. Sorry, it was plus, I beg your pardon. Plus e to the minus 0.1, 0.1, negative, again 0.9048 times 35 is 31.67, which gives the put option sorry, my calculator went wrong. $1.31. And there we are. Okay, that was example 4. Again, maybe if you haven't done one yourself yet, maybe it's time to stop and have a go at example 5 yourself. But whether you're just watching or you're checking, let me carry on and do example 5, the last one. What are the symbols? Well, the current share price, so PA, the current share price is $1.50. I'll work in cents again here, 150. PE, the exercise price, is 180. Time to expiry is 3 months or a quarter of a year, 0.25 of a year. The risk-free interest rate, 10% or 0.1. And the standard deviation, 40% or 0.4. D1, well, it's a log to the base e of PA 150 divided by PE 180 plus R 0.1 plus 0.5 times S squared 0.4 squared. Oops, sorry. Times T. T was 0.25 divided by S 0.4 square root of T square root of 0.25. Now be careful here because the first term, log of 150 divided by 180, 150 divided by 180 is 0.83 something. ln, it comes to minus 0.1823. I said earlier it can be negative. In fact, you may remember from school the log of a number of less than 1 is going to be negative. So it's minus 0.1823 plus, well, if I do the n first, 0.4 squared times 0.5 plus 0.1 times 0.25 is plus 0.045. Divided by, well, 0.25 square rooted is 0.5 times 0.4 is 0.2. So minus 0.1823 plus 0.045 divided by 0.2. It comes to minus 0.6865. D2 is D1 minus S root T minus 0.6865 minus 0.4 times root 0.25, which is minus sorry, that's gone wrong. 0.25 rooted times 0.4 equals minus 0.8865. Now the normal distributions, so put them to the nearest two decimal places. So ND1 is N of minus 0.69. And remember, because it's negative, we're going to get the table figure, but we subtract it from 0.5. The table figure, simply look up 0.69, ignore the sign for the tables themselves, so 0.6 row, 0.09 column is 0.2549, and so 0.5 minus that is 0.2451. ND2, N of minus 0.89. Again, negative, so subtract from 0.5, and 0.89, 0.8, 0.09 column is 0.3133, giving 0.1867. Now, in the full formula, the value of a call option, it's PA, which was 150 times ND1, minus PE, which was 180 times ND2, times E to the minus, what is it, R times T. Well, again, to save time, R is 0.1, T is 0.4. So what's it come to? 0.04. Well, you should be good at this by now. Check. 150 times 0.2451 is, I'm doing in cents, so keep to the nearest cent, 37. Minus, if I do the E first, 0.04, negative. E to the power is, so it's 0.96 times 180 times 0.1867 minus 32. There is the value of a call option, 5 cents. Finally, the value of the put option. P is C minus PA plus PE, e to the minus RT. C we've just worked out was 5 cents. PA, current share price $1.50. PE, the exercise price $1.80. Times e to the minus, as before, 0.04. Which is what do we get? 5 minus 150 plus 173, 28. And incidentally, without wasting your time, again, see that it's not a silly answer. The current share price is 150. Now, if this was a call option, then at the moment it's worth nothing. if it were exercisable now, I beg your pardon, if you were exercising it now and be worth nothing, you wouldn't pay 180 for a share worth 150. We're going to do it in 3 months' time, so there is a chance, obviously, that in 3 months' time the share price has gone up a lot. It'd have to go up a lot to be worthwhile, obviously, more than 30 cents. And so I'm not surprised the call option is fairly cheap. It's only 5 cents. On the other hand, of course, the put option, although the share price may well have gone up in 3 months, the put option is worthwhile provided the share price in 3 months is less than 180. Well, I think you'd agree the share price may well go up, but I think it's more, there's probably a bigger chance it'll still be below 180 than it'll be above 180. And so I'm not surprised that a put option here is more expensive than a call. Okay, well that's the option pricing. There's one more bit of numbers to make sure you can deal with, something called the delta hedge. We'll have a break and then I'll explain the delta hedge. But you'll see there's very little extra arithmetic involved.